Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today is Hawaii's favorite economist, Mr. Paul Brewbaker. Aloha, Paul.
Aloha, Patrick.
So a lot to get to. One thing, we're looking at the data, it appears that the home and condo market is separating again. We've got home sales are up, condo sales are down. There's a pileup of inventory in the condo market. There's actually 72% more condos on the market than just a couple of years ago. We might be in the middle of a buyer's market. We're going to take a look at that in a second. Interest rates have been over 7% all year. We're going to bring in Anders to see exactly where they are today. And based on Fed Chairman Powell's recent comments, it looks like rate cuts are unlikely anytime soon. And I've got some really interesting data on the actual commission rates on Oahu over the past couple of years. And I pulled this up in response to all of the NAR news that's come out, but I was really surprised by it. I can't wait to show you, see what you think of it. But Paul, let's start with home prices on Oahu. And let me pull up the data here.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
For single-family homes, we're at $1.1 million compared to a year-to-date 2023, up 6.2, down 2.5 compared to 2022, and up 42% compared to 2019, where it was 775. And let me just run through this with the condos as well, and then I want to get your comments. Condos at 528, we can see it's up slightly 2% from last year. It's actually even compared to 2022, and up 27% compared to 2019. And Paul, we did this last time, but if we look at single-family homes, 42% higher than 2019, divided by 5 years to take us to 2024, roughly 8.5%. If we do the same math for condos, roughly around 5.5%. Where are we on the trend line? And are we seeing a separation again between the two different markets?
So 8 times 5 is 40. You got to remember there's compounding. So let's call it 8.
Right.
And then 5 years, 5 times 5 is 25%. So again, compounding adds a couple extra percentage points.
Yes.
So 8 instead of 4, which is what it used to be for single family homes, and 5 for condos, which is what it used to be for condos. So let me show you, because this is a really important point.
Yes.
In trying to think through this separation. So here are the prices that the Honolulu Board publishes after seasonal adjustment. And what I've done is I've fit 2 different trend lines, one through the single family data set, one through the condo data set, single family prices on the right, condo prices on the left. The scales are equiproportionate, slopes are percent changes. So I'm not playing around with the scales to, distort the picture. This is really what they look like relative to one another. And if you see in this fine print, condos from 2012 to 2019, that's that 20 teens trend, condos were appreciating during the 20 teens at, wait for it, 5%. And how much have they gone up with compounding over the last 5 years? 5%. And so you see here in the bottom series, the lighter blue series, measured on the left scale, that condos have essentially fluctuated narrowly around the pre-pandemic trend, whereas single-family homes, the darker blue series, went through this post-pandemic surge, a kind of a donut effect, where housing demand moved away from the urban core towards suburbs and exurbs temporarily, as people sorted out, if they didn't have to commute to work, where would they rather live if they weren't required to live as close to their workplaces. Now that took a few years to sort out, and of course, the rise in mortgage interest rates really shut, the window of opportunity for many. But you can see how different the outcome is. Where does that 8% come from for the single-family homes when the trend pre-pandemic was only 4%? And the answer is the overshoot never went all the way back to the prior trend. The path now, which is parallel to the previous trend, to the pre-pandemic trend, the path is now moving at a 4% rate that is maybe over the last 5 quarters, but it's got this extra bump, this
Right.
kind of
So
a
it looks like
ratchet.
it's bumped up into this new
It's
level, but now
bumped
it's
up.
maintaining that
There's
4.
a
But in comparison,
exactly,
we see
exactly.
we see the 8. Very
And so
interesting.
you got to be careful. You get the 8, you get a 4% trend like you did before, plus you got the 4% remote work bump. The donut effect created that 4% bump up in prices.
Yeah. Okay. Yeah, that makes sense. That makes a lot of sense. Let's talk quickly about inflation. We don't have to spend too much time on it, but despite all the hawkish monetary policy from the Fed, inflation is still
Yeah.
sticking around, which spells kind of bad news for us, relationship to rates. What is holding it? Why is it just so sticky despite all the efforts?
Well, let me go back to the home price graphs. This surge in housing costs has worked on rents here in Hawaii, which is the way the Bureau of Labor Statistics calculates inflation. So after the pandemic, you see here, you have the post-pandemic spike, which was supply chain disruptions as well as monetary and fiscal policy stimuli to get the economy going again. That created an inflation surge that the Fed has been trying to tamp down. And then just the last 6 months, these are bi-monthly measures for Hawaii. You see Hawaii's inflation rate, which was already down to 2%, 2.5%, you see it jumping. That's that housing cost statistical anomaly
I
blasting
see.
in. It's a lagged effect. It's blasting through the consumer price index right now. It'll probably burn off because right, we're back to the 5% condo trend, the 4% single family home price trend. That bump has to work through the statistical measurement of CPI before it peters out, maybe later this year if we're lucky. And the Fed can sort of, declare victory and will and feel more confident at that point that it can lower interest rates without the risk of adding additional inflation. I just pulled the
Right.
S&P 500 index through today just to give you a feel for how when we got to March and people were concerned about that bump in the housing cost component of the inflation numbers, they began to pull back from the bet that the Fed would lower interest rates by mid-year, and that caused the
Mhm.
stock market to decline. You see over most of April, but subsequently the U.S. inflation numbers have kind of come back into line already, and the prospect for lower rates a little further out in the year, they're going to skip this month or two right here,
Right.
has already renewed or revived the expectation that the Fed eventually will get around to lower rates because eventually the inflation will actually come down and the stock market
Yes.
has taken off again.
Okay. Yeah, that makes sense. And let's bring in Anders Hostelley, Senior Vice President at Guaranteed Rate here in Honolulu, Hawaii. Anders, how
Hey
are you?
guys, how you doing?
Looking smart with that new haircut.
You like that, huh? High and
I
tight and
do
tight.
like that. Um, Anders, let me ask you. So this month,
Sure.
at one point, I think rates, a 30-year fix, it was up around 7.25,
Mhm.
and it's been kind of floating above 7%. But I think you have some good news, and I know we're talking about the vanilla 30-year mortgage.
Right.
Where are rates today, right now, in the 30-year?
Again, how I always say it's somebody with, excellent credit, like a 25% down payment. That's sort of what I track. As we're looking at mortgage rates, we do this monthly, but yeah, we're actually rates have improved in the last week. So now we're almost like right around the mid sixes. Um,
Really?
It's kind of interesting, right? Over time, I would say, mid sixes, oh, it's really high. But, again, historically, that's not that high. And then if you look at in the last, several months, that's a nice improvement that we've seen.
Oh, how about that?
Yep.
I
Yeah.
just pulled up the interest rate data
Mhm.
from Freddie Mac, and as of today, they're still showing the rate
Yeah.
over 7. But I'm really happy to hear that that
So
it's
yeah,
about to.
rates. So this week, there was some really good, inflation numbers that came out. The market really liked that. That's why we see the stock market Dow as they going up, in a nice fashion. So
Right.
that's helped, mortgage rates. So yeah, so it's definitely good. It's nice to see that. We've even had borrowers that were locked in and asking, hey, can I get a little bit of a lower rate? And we do have, at our company, the ability to do that is, under certain criteria, if the rates drop by a certain amount, we can
Yes.
look at it, giving them more of a current interest rate, a lower rate.
Right. Yeah,
Yeah.
funny. I never thought I'd be celebrating
I
6.5%
know,
rates
right?
right now,
Yep.
but I'm pretty, it sounds like a good thing. And then uh, what about adjustable rates? Are they spreading it out is there a spread at
A
all that
little,
makes those
a little
attractive?
bit. Yeah, a little bit. I just saw somebody lock in the office, one of our first-time home buyers on an adjustable rate mortgage. Because yeah, that there was, there was a time when rates move up, and all of a sudden the arms are almost the same as the 30-year fix. So why go with an arm? But now that as the rates have just come down the last week, we're seeing the arms, that spread kind of widening a bit. Where maybe it's worth taking an adjustable rate mortgage.
Would you say if we're at 6.5 on the 30 that it's around 6 or six and a
Yeah,
quarter?
6.25, 6.25. Yeah.
Six and a
Mhm.
quarter. Okay. Oh, that's
Yeah.
good to hear. And I know figures vary on this, but I think 85% of the mortgages across the US are at 5% or below. And the average is just below 4%. To
Mhm.
start to see movement again, where do you think rates need to be? Five and a
Yeah,
half?
well, I think 5.5, 5.25. I think that would really make a big difference.
Yeah.
And people that have a 3.5%, loan, like, oh, wait a minute, if I sell and I go into a 5.25, okay, the payment difference is much. But right now, if somebody has a 3.5 rate or a 3% rate, and then they look at moving to a larger home or something, they really are looking at what that new payment would be with a much higher interest rate, right? So
Right. Yeah.
call it the
Yeah, that
locked
makes
in
sense.
effect, right? Yeah.
Yep, gotcha.
Yep.
And Anders, I know we've talked about this before, and you and I and another gentleman are going to do a special on this issue, which is the insurance. Just going to call it the
Mhm.
insurance crisis facing the
Right.
condo market in Hawaii.
Mhm.
Can
Right.
you touch on again the two big issues right now that condos are facing?
Well, I mean, condos, and if you look at Honolulu, you'll see condos that were built in the 60s, 70s. So over time, deferred maintenance, water leaks, spalling, things that elevators, just common maintenance that takes place. A lot of those condos, it's coming. They need to do a lot of work, and maybe they put it off. And now it's become more of a financial issue, and there's claims because there's leaks, and because there's so many claims there, it increased the cost of insurance for when the renewal comes up, for the insurance company to say, okay, I'll still reinsure or give this master insurance policy, but the premium's going to go up. There's so many more claims.
Right.
And now there's an issue also with hurricane insurance, in the states, and some of the insurance providers that were insuring for hurricane now are capping how much they'll insure.
Yeah.
So that's become an issue, and even with the cap, the cost is double or tripling
Right.
on renewals, right? So,
Right.
or
Yeah.
had
So
been.
so
So it seems like it's leveling out, but
yeah.
it's still, when you're looking at maybe like 2022, 2021 premiums to today in
Yes.
2024.
Right. Yeah, skyrocketing, and some of the big
Yeah.
providers are pulling out entirely from the state,
Hmm. Hmm.
lessening the pool. So the mismanagement on the building certainly causing big insurance increases, and then this deductible and the underinsured on the hurricane is a big deal. I know that the insurance, the deductible, and the underinsured issue affects lending, and that's affecting value because in a lot of buildings can't sell. And I heard you say something recently, which is people who are going to go to look to refi in a building that's suffering from one of these issues, they're not going to be able to refi because they don't have a
Yeah,
secondary market with Fannie and Freddie.
exactly. Exactly. That's the other thing that's kind of out there, but because rates are, still, above what most people have,
Yeah.
um, on their current loans, is not really coming up. But let's say when rates do come down, let's say when they go down to 5.5, 5.25, and somebody wants to refinance their home. Oh, wait a minute, I can't find financing.
Right, right. Okay, and we're going to do a deep dive on this with the insurance expert. I think that'll be really interesting. Okay, I'm going to get your predictions here now. The
Mhm.
market is building in for Fed rate cuts this year,
Uh-huh.
only one or two for the remainder of the year. What number would you put on there, Anders? One, two, more than two?
I'm going to say two. I
Okay.
know last month I said just one, but I'm feeling more optimistic, so I'm going to say two.
Okay, all right.
Yep.
Okay, and then as far as the size of the cuts, what do you think? 25 basis points?
25, 25. Yeah. Yeah.
Yeah, 25, 25. All right. Okay. Well, Anders, thank you very much for coming on. Really appreciate you giving us the up-to-date information. Good to hear it's at 6.5%. If do whatever you can to keep it going down. All right.
We'll do it. All right. Throwing out the
Okay.
good vibes. Thanks. Thanks,
Okay.
Patrick.
All right. I'll see you
Okay.
next week. Thanks, Anders. All
Bye.
right. All right, Paul. Let's switch back to the housing market. And next thing we're going to look at is inventory. And there's pretty interesting information on this as well. Hi, this is Patrick. Be sure to subscribe so you don't miss the next Hawaii Housing Report. At the number of units for sale, this is information from the Honolulu Board of Realtors. Starting with single-family homes, we can see it's up slightly from last month. Compared to April 2023, up over 15%. This is where it starts to get interesting. Compared to 2022, there are 56% more single-family homes on the market. If we go back to pre-pandemic, of course, we can see there's quite a bit of shortage. We're down 60%. And let me run through the condo numbers and then get your reaction, Paul. We look at condo slightly again compared to last month, but here's where the separation starts to occur again. Nearly 40% compared to 2023, 40% more condos on the market right now. And this is the big number, 72% compared to 2022 of April. These are really the numbers I want to focus in on. The difference from 2023 and 2022 compared to right now, and the separation between single family homes and condos. What's going on here?
Yeah, well, of course, more than one thing are possible contributors, and clearly going from a 3% mortgage rate to a 7% or more, and then nicely in the last week or so, pulling back to 6.5%. But nonetheless, moving from 3 to 6.5%, that increase in mortgage rates alone, particularly as you pointed out, when most people or majority of people are locked into low rate mortgages from the recent past, just means that the inventory is going to pile up unless the sales are absorbing those listings. So
Right.
the pile up
But
is
why
more,
separation between single
well,
family and the condos?
there you go. The pile up is worse on the condo side, which should be equally affected by interest rates. So that can't be it. Something specific to condos has to be going on. And you and Anders were talking about this a second ago. Insurance has become problematic for at least two reasons. One is that the vintage for a lot of high-rise, high-density condominium structures, residential condominium structures in Honolulu, is pretty old. I mean, 80% of all the high rises in Honolulu were built by 1981. So maintenance and other, just durability, resilience issues come into play as a result of vintage. But in addition, climate change and related catastrophic outcomes, the wildfire on Maui, and being most recently an example, but it too was associated with a hurricane south of the Big Island. So tropical cyclonic risk, the risk of increasing frequency and intensity of tropical
Mm.
cyclones, means that all residential structures may be charged a higher actuarially fair price for hurricane or wind insurance or flood insurance. But on top of that, there's something about a dense structure, right? If a big wind hits one place and that building is in the way, the damage is going to be really concentrated. Whereas detached dwellings, right, are spatially dispersed and provide a little bit of risk
Right.
spreading, so to speak.
Sure. Yeah, well said.
And
And the net result are the maintenance fees and the special assessments that are taking place in the condo market. It's just knocking some of those buildings right out of the market.
absolutely. Now, I think there might be a third or fourth issue, depending on how we think about this, whether you break the insurance part down into subcomponents. So you have the interest rates, the insurance complex of issues. But in addition to that, the state recently has embraced a policy which enables counties to prohibit short-term rentals ultimately, or at any rate to regulate them more tightly. And so at the margin, that there may be a contribution to this pile up in months of inventory remaining on Oahu that I've illustrated. Again, in the last 4 to 6 months, a big jump in condo inventories remaining, or months of inventory remaining, whereas single family homes you can see have stabilized at about 3 months, which actually in the historic pattern for the mid 20 teens is about right. The absorption is actually much better balanced in the single family space than in the condo space right now. I only mentioned the short-term rental issue because we saw this back in 2019 when the county passed, the city and county of Honolulu passed enforcement rules that were much tighter on short-term rentals than had previously been the case. And then again, we saw it when tourism was shut down for 6 months in 2020, and some investors, were motivated to get out of condos that might have been in the short-term rental pool. You see the new listings as well. You can see people trying to get out of those condos in the new listings data, whereas in the single family segment, there isn't quite as much of a, a fire sale going on, no pun intended. And with all
you
due
mentioned
respect to
you mentioned
high end.
months of remaining inventory, and I found this to be interesting as well. Looking at this, the data again, this is for
Yeah.
Oahu. Traditionally, we think of market equilibrium around 4.5 to 5 months of remaining inventory. Look at the difference, and look where the condo market is: 4.2% months remaining inventory. We haven't seen this for years. This takes into account inventory absorption rate, but I'm telling you, I think it's a buyer's market right now in the condo market. If you can get out there and find something, it's just
Just to
another
give you
separation.
Yeah, just to give you a feel for what some of the new economics of, the post-pandemic structural changes is, the pandemic led people to realize that remote work is feasible, and particularly in STEM occupations, in industries like finance and tech, professional services, where you don't have to be on a job site like you do in construction or in accommodation, for example. And so it's a pattern of workforce structural change that favors higher income households, more highly educated households, so the ones more likely to be able to buy a house, et cetera, et cetera. And we're not going back to the old pattern, evidently. And so what you saw in the Oahu data were that jump, that ratcheting upward of home prices, now seemingly permanent, like an intercept shift permanently in place as we go back to 4% appreciation for single family homes, while condos have stayed on their 5% path, means that the ratcheting up means that, relatively speaking, and only relative prices matter, right? Relatively speaking, condos are the bargain. Well, in addition to that, in addition to the people sort of moving out from the urban core to suburbs and exurbs where they can work remotely, there's a whole lifestyle thing that happened because the relatively inexpensive urban core condos in Honolulu, which fit the lifestyle profiles for younger professionals and whatnot that don't want to live in the burbs, right? That's actually created a relative, not because condo prices went down, because single family home prices ratcheted up, a relative opportunity for them to seek, the urban core living that matches their live, work, play lifestyle. And if we get these lower rates going out of 2024 into 2025 and 26, I think there could be, leaving aside the insurance issues, but certainly for a new condo, I think there could be a real resilience in the demand for a newly minted
Yes.
recent vintage condo product.
That's right. Yeah, and the whole fire safety issue is another one that's gonna be affecting shortly. Okay, let's shift over and take a look at closed sales. Kind of interesting too, and then we're gonna get to the commission rates, which I think is gonna be really interesting. So let me pull up the closed sale data. Okay, and here's the latest data from the Honolulu Board of Realtors. These are the year-to-date closed sales, and you can see up 11.5% compared to last year, down 32% compared to 2022. Compared to 2019, only down 20%. That was surprising to me, 2019 pre-pandemic. And if we look at condos, down 4.3% compared to last year, down 41% compared to 2022, and down only 12% compared to 2019. The reason I find this so interesting is it seems in the business that volume is so low and the whole thing's falling apart. Compared to 2019, only down 18% and 12%. Any comments on that, Paul?
Yeah, let me take the board's data, seasonally adjusted, as I often do, and show you what it looks like when you pair up the sales volumes data with the mortgage interest rate itself. So
Oh, I like this
this,
one.
again, I have to explain this one a little bit, but the mortgage rate's on the right scale and I've inverted it, right? So up is down. So when you go from a 3% mortgage up to a 7 or 7.5% mortgage, which is down in this case, the dashed line, the mortgage rate going up here goes down, and home sales, and I combined single family and condo sales on Oahu here. Home sales just plummet. To your point about, what's a reasonable expectation for Oahu? Well, at this level, yes, the volume is low. It's better than it was, a few months ago, or maybe at a certain point a year ago or so, but it's worse than in 2022 when we had a 3 or 4% mortgage rate entering the year. As those rates go back to the 5.5 or 5.25 that Anders was talking about, right? I mean, if you just I just drawn this arrow, but it's not inconsistent with what you could reasonably expect. And by the way, it doesn't require that the overnight rate target of the Fed go down. It only requires that the long-term rates, like the 10-year Treasury note yield, which today is 4.37, add 150, 200 basis points to that. That gets you to 6.37, which tells you 6.50 is too high right now. It's, that maybe next week it'll be 6.35. And as those longer term rates come down because of the disinflation, and as the Fed ratifies or validates the diminution of inflation by pulling down the short-term rates, these mortgage rates going back to 5 will bring those sales back up. Now, in the late 20 teens, where we had a 4% mortgage rate, there were essentially 800 sales per month combined, single family and condo. And, that's where we're headed if we're lucky. What is it now? As of April, 600. So we don't have that far to go. We're not going to see the kind of volume we had at 3%. And I think that's a key thing to remember. And by the way, for the neighbor islands, it's essentially the same picture. Neighbor islands, Oahu, neighbor islands, Oahu, neighbor islands, Oahu. You get the picture. Falling rates, a normalization of the term structure of interest rates, which should happen over the next 18 to 24 months, will put us back to where we were in kind of the Goldilocks zone of, let's say, the mid to late 20 teens.
Yes. Okay. Yeah, good. Okay. And now this is, as I say sometimes, this is the coolest thing I learned all week. So these are the commission rates being charged on Oahu. So let me pull up this data, and this comes from the Honolulu Board of Realtors. So let's start with this. There's been so much misinformation in the press about this NAR settlement, and I think most of what's going to happen is going to
Please
be very good for
clarify.
our industry. Okay, I'll just give you a
Thank
simple
you.
one.
Get
You can see,
it to me straight, man.
okay, you can see these headlines. Realtors agree to axe 6% commissions in NAR lawsuit. Um, Over and over and over again. I think even the White House talked about the standard 6% from the National Association of Realtors. There has never been a standard commission for number one. Number two, no realtor group sets commissions. That is individually negotiated. I've been doing this for 35 years. We have deals that are 0% being offered up to 10%. It's all negotiable, always has been. So really, what's the rate on Oahu? And this is what's so fascinating. This
You mean
is
it
the
moves around?
so this is the commission rate paid to the buyer's agent on a closed transaction. And you can see where 3% had been the norm for a long time. And it's obvious if you look at the dates, what's happening in those periods of time, but you can see that trending down. And then 2016, a 2.5% takes over. 3% on the decline. And here's another way to look at this. And I want to thank my friend Justin Ching for putting this together for me, because this really
Nice.
shows us as a percentage of sold. The blue are the 3% commissions paid to buyers agents. The green is 2.5%. Clearly, you can see 2.5 has been reigning supreme. And again, going back and looking at the years, we can see what happened, right? You can see when it's a bad market, those rates go up to stimulate sales. When it's a good market, those rates start to come down. Did you think that was as cool as I thought it was?
It is pretty cool, although I have to tell you, this reminds me of this particular chart. I love these charts, by the way.
Yeah.
Reminds me of the COVID subvariant charts that the Centers for Disease Control
Well,
publishes. So,
you're
wow, the new
definitely
subvariant is growing, is displacing the old COVID variant.
what they say.
Um,
Let's not compare realtor
yeah.
commissions to COVID variants. Okay,
let,
we got
let,
enough bad press right now.
let me just jump in with the economics just for a second so people
Yes, please.
understand the bigger picture. Like, we can have a debate over you need a realtor or a chat GPT generated generative AI realtor. I'm just saying, we'll see where this all goes. Do you need an economist or a really good search engine? But the fact of the matter is the price of the house, right? Here's demand, the price of the house, and here's supply. How many houses are there at this lot where this house is? One. There's one house. Now, demand goes up when interest rates are low, and demand goes down when interest rates are high. And the price of the house is the price of the house. How much people get when they fight over who gets the agency or transaction fee? How much does the bank get? How much does the mortgage insurance company get? How much does the Department of the Bureau of Conveyances of the state of Hawaii Department of everybody's in there. Ooh, I want my little piece of it, right? Does not change the price of the house.
It's a very
So
good
y'all
point.
can go duke it out. You can
That's
duke it
right.
out any way you want. And when I look at those Board of Realtors data, what I see is realtors have gotten so much more efficient. Information technology, fintech, the nature of the lending process all have gotten so much more efficient, maybe not the Bureau of Conveyances, but so much of this process, so much of the cost of agency that we used to associate with real estate transactions has been competed away by productivity growth, that to stay competitive, these loadings, these agency costs are much lower than they have been in the past. And that's a good thing. That's
Yeah,
why we have
whenever you have
smartphone
competition,
apps.
right, it's a good thing. It's a good thing. And I'm not going to go on the realtor defending box right now, but I would say finding a home is not the main thing that we do, as you know. It's
Well,
about
I
160 other things in the transaction. But in any
I
event,
will go
yes.
on the economist defending line of
Defend
argument here to
economists,
remind
okay.
everybody. Yeah, I have to do I'm going to mix metaphors with the
Yes.
Star Trek. What
Okay.
is it? The Vulcan
Live
mind
long and
meld, and
prosper. Oh,
instead,
well, okay, yes.
I will do the Jedi mind trick.
Oh,
These are not the droids you're looking for. You need an economist to help you make a good decision.
and you need
These
a
are not the
realtor more
droids you're
than the
looking for,
economist.
and you need.
Okay, all right. All right. Well, Paul, hey, thank you very much. It's always a pleasure. And thanks to Anders Hostelley from Guaranteed Rate for all the information that he shared with us. Be sure that you subscribe down below. You don't want to miss next month's property report. And also, Anders and I are going to put out a special on the insurance crisis, so you'll be notified of that as well. So until next time, be well, be kind, and aloha.
Well, brother.
Hi, this is Patrick. I want to say thanks to Paul and Anders for all the information today, and be sure to subscribe below so you don't miss the next Hawaii Housing Report.